So it's no doubt that the cryptocurrency market has been crashing over the past 3 months, but recently, just in the past month alone, it has been going down significantly. Now, while Bitcoin hasn't really been performing that bad, and it's really just been seeing retracements, Ethereum has been getting completely killed, being down roughly 15% in the past 30 days and over 50% in the past 1 year alone. Now, while most investors will flock over to Solana thinking that it's the solution, Solana is down well over 50% from its previous all-time high as well. And just in the past year, it is down 35%. And don't even get me started on altcoins because those things are bleeding as well. Today, I'm going to be diving into what you should be doing right now if you're in liquidity pools. And I want to be fully transparent with you. A lot of people won't show the level of transparency that I'm going to be showing today simply because these numbers are fucking scary. Okay. And ultimately, if you look at this dashboard right now, this is showing my actual profit loss. This is saying, hey, Jake, you put in $47,828 at the time of deposit into these liquidity pools. And you currently have $32,529 plus $1,490 of earnings, which means, Jake, that you are down $13,808. That right there is a scary number because that is equivalent to 28% of the overall position size. Why? Well, if we look at Ethereum over the past 30 days, it is down 15%. I've been in these positions since March 2nd over here on these two. So basically about a month now. So I've witnessed all that price depreciation, but I've also witnessed the price depreciation from Edge as well as from Tau token. And the reason why is because I have exposure to those in the liquidity pools. Now Edge is up 8% today, but even then over the past 30 days, it's down 26%. If we take a look over at Tau is down 1.6% today, but over the past 30 days, it is down 32%. So we have mixed exposure to both of them, which is why the positions are down so much. And while I can spew all the smoke and basically just say that you should hold your positions, you should not panic sell, and you need to hodl, and you need to hold the line and everything like that, I want to get real today and talk about why, and talk about what that would mean, and if you really should sell your positions. And I'm just going to be front with you guys. If you have exposure to any token that does not have a use case, and I do mean tokens like Fartcoin, and I also mean other tokens that maybe look like they have a use case, but they don't actually have a use case. Or maybe they have a use case, but they don't have any revenue. They're not doing good as a business, right? Or maybe that revenue isn't being injected back into their tokenomics, right? Then you should sell that position and you should get out of there and you should run. And the simple reason why you should do that is because that's not what we're going to see this market. Right now, the overall crypto market is being manipulated, including the stock market. President Trump is manipulating these markets and crashing them on purpose. So ultimately, we can eventually get lower interest rates because otherwise the United States is not going to be able to afford the payments on its debt, which is going to result in a recession. So while these markets are going to continue to crash for another couple months, ultimately we will see a bull run towards the end of this year, and we will finish off strong in this bull run, in my personal opinion, after we've already seen all those economic policies start to pass. But with that being said, that bull run that we're going to see is going to be the rise of revenue-driven assets. Fundamentally, crypto has never been better. We have the United States invest into cryptocurrency, and we have other countries invest into cryptocurrency. Just for reference, the United States holds 207,000 Bitcoin, China owns 194,000, the UK owns 61,000, Ukraine with 46,000, Bhutan with 13,000, El Salvador with 6,000, and Finland with 1,900. So the point is, fundamentally, crypto has never been better. We are seeing mainstream adoption. We are seeing crazy things happening in crypto that I personally never thought would happen in crypto if you asked me a couple years ago, basically. But those things are happening today, regardless of if we thought they're going to happen in 10 years, 15 years, or never, right? They're happening today. Fundamentally, crypto has never been better. If we look at the S&P 500 over the past year, you can see it has started its descent all the way from a price of $6,000 to $5,600, which is 10% when you put that in perspective, basically, which doesn't seem like a lot in crypto to us ordinary crypto investors, right? We're witnessing that in a day. But for the S&P 500, that is a lot of money. We're talking about the people that have the S&P 500 in their retirement accounts that are about to retire that can no longer retire because their retirement account is down 10%. Because the S&P 500 is crashing. That's the thing. So ultimately, these markets are being crashed on purpose so interest rates can be lowered. So number one, that's better for the consumers, but number two, the US can start to pull itself out of debt and be able to actually make the payments on its debt because they are so far in debt to the point where the interest is just absolutely unaffordable. Now, the reason why I bring that up is because we are seeing Made in America tokens. We already know that this is going to be a big deal. We already know that the Trump administration is very big on cryptocurrency. So ultimately, that's why we're expecting the bull run to continue out towards the end of this year. Once these markets have been manipulated, once these markets have crashed, and once interest rates have started to go down, we will see the rise of, number one, revenue-driven projects, simply because people are no longer dealing with the BS. They are no longer investing into meme coins or investing into random altcoins, expecting them to go up just because everything goes up. They are going to be targeting high-quality assets. They're going to be looking and evaluating these assets as if they are making a $10 million VC investment into a company. And not to mention, there's going to be a huge catalyst by Made in America tokens that is specific to revenue-driven projects. And I'm not just talking about investing into random Made in America projects like Dogecoin, for example, which is entirely based on hype. I'm talking about investing to actual businesses, stuff that powers the blockchain, stuff that has real-world use cases, stuff like Link, stuff over here like Sui that has a whole blockchain network behind it, Ondo, Aave, Render. All these are potential projects that could do very, very well because they are revenue driven. They actually make money and they inject that money back into their ecosystem. And on top of that, they're made in America. So these are huge catalysts as well. So my point being, with these positions, if you have conviction in these tokens and you're willing to hold the line on them because you are very, very confident in them, then you should continue to hold. But if you don't have conviction in them, you're more of just in these pools to earn APR, right? And you don't really care about the underlying assets, you're not willing to earn a low APR on them, then you should get the hell out of there and you should run faster than you ever have, simply because those tokens are most likely going to crash. Now you're probably wondering why I'm saying all this as I have a fart coin to Sol position right here that is down $1,000. Well, let me tell you. So this is down $1,036, but I am hedging this position, which if we take a very close look, you could see that my shorts are up $962 and $145, which means that my overall position over here on the short is up $1,100. So if we look over here, last time I checked, $1,100 is higher than $1,036. And effectively, I'm earning about 100% APR in this. So this is a market neutral position. I'm running a strategy that is consistently earning me right now. Basically, after we factor in kind of the discrepancy between the short and the long, I'm earning about $10 per day. Now I'm testing this $5,000, and then I'm going to ramp this $5,000 up to $50,000, and I'm going to continuously inject more capital. Point is, I'm getting creative. I'm using other strategies. I'm starting to hedge my positions, not my main positions that I want to accumulate more assets in and grow my bags, but any new injections that I'm doing, a lot of that is actually in stuff like Fartcoin to Sol, where I'm hedging, or stablecoin positions. I have $10,000 over on Fluid Dex, right? And the reason why I'm doing that is because instead of injecting that capital and just buying up these assets right now, which I could be doing, well, guess what? My liquidity pools like Edge and Ethereum is accumulating more Edge for me. Ethereum and Tau accumulating more Tau for me. On top of that, these market neutral positions like Fartcoin Sol, that yield is being used to accumulate more Edge, more Tau, more actual assets. So I'm buying the dip in many ways, except my strategy is a lot more safe than just putting the money straight into Edge and straight into Tau in the scenario where we do have to wait a long time for these assets to rise again. Now, before we go any further, I do ask, if you guys are enjoying the content here, you find it valuable, just make sure to drop a like, subscribe, notifications turned on. And if at any point you do need help with your portfolio, we are happy to help you. And I do want to go ahead and mention that I am not the only one that is doing a strategy like this where I'm focused on accumulating more assets. So for example, what I'm doing on my current portfolio, when we factor out that Fartcoin position, I'm doing an APR of roughly 62% per year. That's 5% a month. I'm pretty happy with 5% a month, right? I was used to the 120% APRs, but we had to adjust our expectations because APRs have gone down. If we try to chase super high APRs, it is going to blow up in our face because the market has changed. The market fundamentals have shifted. I'm doing $46 per day, which I'm happy with because that's $1,400 per month. And that $1,400 per month is money that is accumulating more assets, basically. Now, again, I also have this other position over here on the Solana network. This one's Sol Render. This one's doing $41 per day. That's $41 per day. That's on top of what I'm currently earning, and that's accumulating more assets. Now, again, I am not the only one running this strategy. Over here, we have a member that's in Arrow and Ethereum. They're down $1,700, but they are profiting versus HODL, and they have a very solid divergence loss profit margin. They're doing a 57% APR. They're making strategic decisions. They were in range for a long period of time, and they just recently went out of range. They could have done a better job rebalancing before they go out of range, especially considering the fact that they did have some time before going out of range. This is just one of our members. We have another member over here, $165 in earnings, $150 profit versus HODL. These are positions that have been open anywhere from a few days to over a month, basically, and they're all profiting compared to holding the market. Why? Because the approach that they are taking is more long-term. It's more strategic. They're not thinking about tomorrow. They're thinking about a month from now. They're thinking about 3 months from now, 6 months, in a year from now, when these assets are doing better, if they are even doing better. So this portfolio is doing $260 a month off of $5,900. It's not bad whatsoever. Over here, we have a $24,000 portfolio that is profiting $771 compared to holding in the market, and they have $1,200 in earnings. They're down 23% ROI, so they're down $7,700 overall based on what they injected. But they're doing an 83% APR. They're doing $56 per day off of these positions, and they're using ENA and Morpho, which are two very, very high quality assets, to be included into a portfolio. So the point is, a lot of people throw their wallet into Metrics Finance, throw their wallet into other tools for tracking and stuff like that. Hey, some people don't even track, and that's hurting them to the fullest extent. But when they look at it, they see this number and they think that their portfolio is bleeding. Their portfolio is like in the gutter, right? What I look at is this number right here. And this number is an indication of bleeding, because I consider bleeding as in you are losing assets, as in you put 10 Ethereum value in, you now have 9 Ethereum value, right? You just bled 1 Ethereum basically. That's how I look at it. A lot of people look at, oh, I'm bleeding dollars. And why are you in crypto? Because crypto is volatile at the end of the day, right? So with versus HODL, what we're paying attention to here is how we're performing compared to the overall market, which means in this case scenario, this person is profiting $771 compared to holding in the market and compared to the market. So again, it really comes down to what we want to benchmark against. If you are a crypto hodler and you believe in this bull run and you think that the market's going to finish off, then you should be investing into assets that are, correlated with Ethereum, that are going to do well in the long term. And you shouldn't be focused on APRs. You should be focused on accumulating more assets. That's great. Focus on versus HODL. Whereas if you are focused on, let's just say, cash in, cash out, I put $5,000 in, I want to take more than $5,000 out, you should be hedging your positions and you should be running stablecoin positions. You're not going to get as high of APRs, but at the same time, you're not going to have exposure to the market. So that's what I would be doing with the Fartcoin position that I just showed you, where I'm profiting on my short but losing on my long, but ultimately I am creating income. That income right there is the main profit. So to answer the question of if you should sell, guys, you should only sell if you're not confident in your positions, if you're not confident in the market, and that really comes down to you. There's no specific indication like if your positions go down this much, you should sell, because really all these assets are completely different. So there's no set framework for that. There's no set guidelines or anything like that. It's just if you're confident in your positions and you're confident in the assets. And if you're unsure about how you can get confident in the assets, again, that's where you need to start to adjust your strategy and make sure that you actually are doing research and put a process in place for doing that research. Guys, if you need help with your portfolio, implementing a strategy that can accumulate more assets, or of course, help you be delta neutral so you don't have market exposure, there is going to be a link right below this video to apply to work with us. There'll be a short application, take you like 5 minutes. From there, you can hop on the phone with my team. We'll make sure we're a good fit for you, but also you're a good fit for us. Just make sure it aligns, and we'll go from there. But otherwise, drop a like, subscribe, notifications turned on, and I will see you guys in the next video. Peace out.